you give us just a few minutes of your time, we can teach you the two models that have changed both of our lives and helped us both generate multiple six figures in prop firm payouts.
I'm Sean, and I built the OP model.
I'm Nick, and I built the trigger model. Both models promote a precise and simple view of the market.
By the end of the video, you'll know how we find a bias, where we enter, and how we manage risk.
Instead of taking up a bunch of your time going over all the confluences that we use one by one, here is a quick glossary going over each term with their definitions. If you have any further questions or want to learn more about these confluences, just leave a comment down below.
Now we're going to get into the shared framework of each of these models. For our first step, we are identifying our bias. For clarification, we do not tie ourselves to a certain bias. We simply use our bias to help find the distribution on the higher time frames.
When finding our bias, we start at the top and we work our way down. We use the daily, the 4-hour, and the hourly timeframes and identify the higher time frame trends.
This is an example of a 4-hour bullish trend. As you can see, we are formulating higher highs and higher lows. And here is an example of a 4-hour bearish trend. As you can see here, we're making lower lows and lower highs.
And just for full clarification, we are not tying ourselves to one direction of the market or to our bias. Trading with your bias will just simply increase the probability of your entry. With these two models, we are simply focusing on trading reactions and not reversals.
After we have a general idea of the direction, we need to find a where, and that's our area of interest. An area of interest is simply a level that we expect to have a reaction off of.
With our models, we use three specific AOIs: change in state of delivery, rejection blocks, and OTE. Now let's get a little bit deeper into these three areas of interest.
The first area of interest is a change in state of delivery. A CISD is the initial shift in market structure. Here's an example of a bullish change in the state of delivery. It's a two-candle formation where the second candle engulfs the first candle in the opposing direction. And this is a quick example of what a bearish change in the state of delivery looks like. We use this area of interest as a level of rejection, where we expect price to retest and reject. This is a simple example of price retesting a change in state of delivery. As you can see, these are precise and consistent levels that produce distribution in our direction.
And for our next area of interest, rejection blocks. A rejection block is a candle that sweeps liquidity but fails to close above or below it, depending on if it's a bearish or a bullish example. These rejection blocks can help locate the initial spark of a reaction or a reversal. Here's an example of a bullish rejection block. As you can see, price wicks down but fails to close below the liquidity. We will then constantly have a retrace to CE, which is the midpoint of the rejection block. From CE of these wicks, price will often give a good reaction, which we can capitalize on and catch trades off of. Additionally, here's an example of a bearish rejection block, and as you can see here, we respect the CE of this as well.
Last but not least is OTE. OTE is a Fibonacci retracement tool that helps locate the bottom of retracements within a price leg. You can locate OTE by utilizing the Fibonacci retracement tool, which can help you find the top or bottom of a retracement within a price leg.
Here are our Fibonacci retracement tool settings. The levels we use on the Fibonacci are the 1, the 0, the 0.5, 0.618, 0.705, and 0.79. For our areas of interest, we will only be focusing on one of these levels, which is true OTE. True OTE is the 0.705 level, which is the midpoint of OTE.
It is important that you measure OTE from wick to body. As you can see in this example, price is in a bullish trend. Price retraces down to the 705, creates a lower high, and then extends up to make a higher high. As you can see here, we can utilize true OTE as a spot for an entry and ride the wave.
Now that we have gone through all of the AOIs, let's move on to key opens.
Key opens are similar to area of interest, but instead of being based off of price action, they are based off of time. The 4 key opens are new day open, which is 6 p.m., true day open, which is midnight, 2 a.m., and then 10 a.m. 2 a.m. and 4 a.m. are both 4-hour candle opens. Instead of wasting your time marking it out yourself, I created an indicator for my premium Discord where it automatically marks these out. If you want access to this indicator, the link is in the description. These key opens honestly feel like a cheat code with how clean the reactions are. And honestly, it's a mistake not having them marked on your chart. As you can see here, here, and here, these key opens offer clean reactions. What really excels our models above others is combining these key opens with our area of interest.
And now, combining everything that we've learned up to this point, let's present to you the two models in depth. The first model we will be going in depth on is my model, the trigger model. Here's a simple checklist breaking down the trigger model, and it is in 5 simple steps. Step 1 of the trigger model is to identify the higher time frame trend and form a bias. Step 2 of the trigger model is to identify your AOI, which is the change in state of delivery, the rejection blocks, the OTE, or your key opens. Step 3 of the trigger model, once you identify your AOI, is to set a limit at the area that you expect rejection. Now here's where my model gets unique. Step 4 of the trigger model is to set a strict risk to reward ratio of a 15-point stop loss and a 45-point take profit. The reason for this is to make this model completely mechanical, to take all discretion out of it. And the last step of the model, step 5, is to let the trade play out. Trust the 60% win rate of the model. Don't play around with the stop loss, don't close early, and don't go break even. Now I'm going to get into some examples of the trigger model playing out.
As you can see here, it is 9:30 a.m. and market has just opened. Some things that I will be watching and want to mark out are OTE of this pre-market price leg, which I will mark wick to body on the 3-minute time frame. Another thing that I will mark is these internal change in states of delivery. We have one down here on the 5-minute. So I will mark 5-minute change in state of delivery. We also have one external 5-minute change in state right here. Moving over to the 15-minute time frame, you can see we have a 15-minute change in state of delivery right here as well. So let's now watch as market open form some price action. As you can see, I am adjusting my OTE to hold the wick to body measurement. And on top of that, it is pretty clear that we have a very strong rejection zone sitting right around here. So as I am watching the price action pull back, I am preparing my long. I am deciding to take it from the lowest change in state of delivery, which is the higher time frame one, at the 15-minute change in state of delivery, which, keeping in mind, is resting at the bottom of OTE, the most premium long area. I'm going to adjust my stop loss to 15 points and bring my take profit to 45 points. And from here, I'm going to set a limit order of however many contracts works best for me. And then the last step of this model is to let price action play out and let the model do its thing. And as you can see, in 2 candles, we are in 45 points of profit. As you can see here, it is 10:35 a.m. in New York session. Price has manipulated to the downside and then started to distribute to the upside. We formed this 5-minute change in state of delivery right here, which I am going to mark out like this. We came back and we tested that 5-minute change in state of delivery, which creates a rejection block, which I will mark out like this. And moving to the 3-minute time frame, you can see we are a bit overextended and have not balanced out price, so I will mark OTE out by measuring the wick to the body on the 3-minute time frame. And moving down to the 1-minute, I'm going to sit and I'm going to watch as we retrace down to our zone. Now entering this trade, it becomes a bit technical because there's multiple levels that we can enter off of. It will always be safest when utilizing the trigger model to enter at the lowest and most premium level of your zone. And for this example, I'm going to take this 0.618 OTE level just due to it being tied with the 5-minute change in state of delivery and the rejection block. I'm seeing that this area right here could give the reaction prior to reaching the 705, so I'm okay with taking it from the 618. So I'm going to place my buy order and I'm going to bring my stop loss up to 15 points. And now that my stop loss is at 15 points, I'm going to bring my take profit and put it to 45 points. And from here, I'm going to set a limit order of whatever size works best for me. And watching as price comes back and retraces into our zone, you can see we get tagged in and put into profit within 2 candles. This is a prime example as to why we are always using limit orders instead of market orders, just due to how fast and aggressive this reaction is.
This model has statistically proven to have a 60% win rate with a 1 to 3 risk to reward, and is the more mechanical of the two.
Now I'm going to break down my model, the OP model. Again, here's a checklist breaking down the model. Step 1, we are forming a high time frame bias, looking at the trend. Step 2, I am identifying an area of interest near a key open. Step 3, I am placing a limit order at a key open. This is where my model differs from the trigger model. I always put a limit order at a key open rather than an area of interest. Step 4, for my risk management, I will put my stop loss below a protected low or high, and then my take profit at a liquidity pool. Step 5, similar to the trigger model, I am not going break even and I'm not trailing my stop loss.
Alrighty, I'm going to go over some trade recaps for the OP model. Um, all these trades were taken in the same week this was recorded, just so it's not cherry picked. I'm also only going to show 2 trades. Both of these are the trades I've actually taken in the live markets in my Discord. Our first step, as always, is our high time frame bias. As we said, we usually keep a very loose bias, and what we're looking at majority of the time is just the trend, right? So right here, we see trend equals bearish. We are very, very clearly displacing to the downside, right? But that being said, I'm always open to changing my bias. This is just where my head should be at right off the bat, right? Also marking out high time frame PD arrays. Here we actually have a low about to be swept, and then a new week gap. So this is all I need to start my day. I have a bias and then I have some PD arrays. Okay, cool. Now we go into our second step, which is we need to find an area of interest near a key open, right? So what I'm looking out for is watching this daily low. If we were able to, one, get a retrace back up to 930 or a retrace up to 830, then we could have taken the shorts, but this retrace to 830 was right at 930. So there was no real entry. I'm not entering right when our market opens. And then there was a retrace up to our 2 a.m. But as you can see here, this was at 8 in the morning and I was still sleeping. So what am I going to do now is I am just going to simply wait. Our major draw on liquidity has already been swept. So my bias of going short is taking a hold and I'm waiting to see more structure build. As you can see here, price made a V-shaped recovery, completely changing my bias of shorts. Right. So this is what I mean by keeping our bias open. Now I'm looking for longs. We are delivering off of these high time frame PD arrays, and we had a huge pump to the upside. So we circle back down to our second step. And our second step is we're looking for an area of interest near a key open. So looking at 10 a.m., which lines up perfectly with our 8:30 as well, we can now start looking for an area of interest in this zone. Now what can we see? We have a 30-minute change of state of delivery right below our key opens. Now that I see 2 key opens in the same area, sponsored by a 30-minute change of state delivery, all I need to do is place my limit order. As you can see here, I'm going to place my limit order on the lowest key open just to try to milk the most RR. My stop loss will go below this 30-minute change of state of delivery, as this price is the last area I want to see be retested before going upwards. Put our limit order at the 8:30, stops, hugs below the 30-minute change of state of delivery, take profit all the way at the external high. We place our limit order, price comes back down, retest our 830, and bada bing, bada boom, smacks full take profit. Right? So from step 4 and 5, take profit at external liquidity. 5, no break, even, no trap. We let it run. We let it run. We don't get emotional. We don't do anything. We let it run. Alrighty, now going on to our second example. This trade was actually the Thursday, the day right before the previous example. And I'm just going to go over the same exact thing, the checklist that we use from top to bottom. First things first, again, form bias. Again, we are in a bearish bias. We are trending downwards. We are just moving straight downwards. That's it. So right off the bat, again, we keep a loose bias, but I am looking for shorts. That is the main thing. We are more likely to expand to the downside than we are to expand to the upside, right? Step 1, we found our bias. We are looking for sells. We are open to changing it, but we are just looking at shorts for the majority of the time. Step 2, we're going to identify an area of interest near key open. As you can see now, all of our key opens are way, way, way up here. So what am I going to do? I'm going to wait for a new key open to form. And when is that going to form? At 10 a.m. So I'm waiting for 10 a.m. to find a trade. As you can see here, 10 a.m. forms. We have this wick right here, but it does go against our bias, and that's okay. We can still find a trade off of it if you want to or not. Then you're just going to have to adjust your risk accordingly to how the market's moving. As the market starts to chop here, we can actually look for a few things. We can look for our area of interest near key open. So at 10 a.m., what do we see here now? Here we don't have any strong areas of interest, so this is why I'm going to fade this long setup and just wait for a short. To wait for a short here, I have to see price break below the 10 a.m. and then come up and retest it to continue down. As you can see here, we did have a bounce off of 10 a.m. back to the upside, but personally, I faded this trade just because price was slowly chopping back down and we didn't have any strong areas of interest near our 10 a.m. Okay, boom. Here we can see we break below our 10 a.m. Then we have a continuation change in state of delivery to the downside on the 15-minute. So now we are aligning an area of interest with a key open. So what is our third step? Place limit order. And as always, we always place our limit order at that key open. In this case, it's 10 a.m. Then, of course, we need to find a stop loss and a take profit. In this example, our stop loss is going to be above this 1-minute high, which is also above this 30-minute change in the state of delivery. So is our stop loss protected? Yes. Second step is take profit. Where's our take profit? This is external liquidity to the downside. This is hourly liquidity. This is a low that we were trending to the downside. So where's TP? External liquidity. Now we go on to step 5. What is that? No break evens, nothing. No trail. We let it play out. So let me place my sell limit. Stop loss here. Take profit down here. We stop loss. Enter. Let the trade play out. Bada bing, bada boom. Tagged in. Don't move. Nothing. We just let it play out. And bada bing, bada boom. We hit take profit. So if you use this exact model in the past 2 days, you would have been up 9R with no losses.
The OP model has a lower win rate at 45%, but it allows me to catch higher RR trades.
So here's a graphic that compares both models side by side. The similarities between both are identifying higher time frame trend, all areas of interest, all key opens, how we enter with a limit order, and not trailing or going break even with your stop loss, just letting the models play.
The differences are in the entries and the risk management. The OP model's entries are anchored off of key opens, where the trigger model enters off of a strong area of interest. Now looking at the risk management, the OP model is open to letting trades run longer, while the trigger model has a set RR.
Neither model is better than the other, but selecting which model works best for you is priority.
Now this is obviously a quick breakdown of our models, so if you want to learn more in depth about these models, then join our premium group where we are actively live streaming and giving live signals every single day. Now if this video helped you guys out, leave a like, comment, and subscribe.